Seema, it's interesting because I was out in Las Vegas covering the Super Bowl and talked to some of the players, one of whom said to me, I think the Fed chairman is just really trying to keep the markets in check. Is the Fed right now trying to keep everyone from pushing too hard for rate cuts sooner than the Fed thinks is possible?
So good morning. I think that is one of the kind of the key messages that you're hearing from Fed speakers. I think with the market at the end of last year expecting 6 to 7 rate cuts for this year, that did seem very optimistic. So it makes sense that the Fed is pushing for that. If the market continues to expect a lot of easing, then that means that you're going to see considerable financial conditions easing, which actually increases the risk of inflation pressures picking up again. So I think the communication is a key part of the Fed's task. But of course, just like us, they will be watching the data. They are still data dependent, which is why the CPI data this week continues to be very important.
If consumer prices come in where expected, what do you think then will be the reaction from the Fed?
I think it's in line with what the Fed is expecting, so it just doesn't change their trajectory. So we've been hearing from them recently that they're thinking more 3 to 4 cuts this year, so less than what the market is expecting. So if you get a CPI number in line with expectations, then that's just a key message that the Fed can stick to. The market may not necessarily like that at this stage, but we have been seeing that the market is moving closer and closer to the Fed's expectations, which should mean that over the coming weeks and months, that bond volatility, equity market volatility that you have been seeing starts to fade away.
All right, talk to me then a little bit about, on the heels of the economic data that we'll get this week, how do you position resources? How do you position investments? How do you take advantage of whatever cash has been sitting maybe in money market funds and make it work for you?
So I think this is a really important time for investors to be preparing their portfolios. We've already seen equities do very, very well in the last few months and even in the first few weeks of 2024. That is likely to continue, particularly when you get Fed cuts, which is accompanied by a strong economy, or at least a slowing economy and not a recession. That is typically a great time for equities. So we should see investors thinking about where are the valuation opportunities, thinking about the areas that have been maybe quite unloved last year, so thinking small cap value. Those are the areas that I think we can potentially do pretty well for this year. So it is important that investors start getting ready and focusing on those areas that can typically and historically do well in a Fed cutting cycle.
Are you concerned at all about reinflation?
I think it is a risk that investors do need to be concerned about, or at least watching quite carefully. We have already seen that the core goods prices have started to show a creeping up of inflation. At the same time, some of the Middle East tensions are showing through in those shipping costs. So there are certainly risks out there. It's actually one of the reasons why we think that portfolios should still have some element of inflation mitigation, whether that's focused on real assets, infrastructure, just to make sure that if there is that risk of inflation reappearing, their portfolios are still protected against that threat.
And when you're watching where we are in the earnings season, do you think that the earnings reports are still connected to what you're seeing with equities movement?
I think they are, actually. The earnings season has been quite strong. And one of the best things that's come out from there is this proof that actually consumer resilience has been maintained. So companies were quite cautious last quarter, but now I think they're feeling reassured that consumers continue to be fairly strong. And this is one of the reasons that you're seeing the equity market continue to perform well. The one bit which doesn't necessarily connect, though, is at the moment the rally continues to be quite narrow. It's still driven by those few mega cap technology companies. So as we go through the year, we should see a broadening out of that rally. And maybe those mega cap tech, although they continue to perform well, they probably don't see as strong a performance as they had in 2023.
Seema,